To see you guys here, and I think there's streaming as well, so I think the audience is all clued in. Uh, Before I start off with the conversations with the panelists, let me invite each of them to say a few words about their background, so that we all have some context of who these people are, and then we can put their comments into that context as we start the conversation. So let me start with you, Hero. A couple of words about your background, your fund, so that we all know and we get familiar with that.
So my name is Hero. I'm managing partner at a fund called Beenext, based out of Singapore. We invest in India, Southeast Asia, and Japan. Early stage investors, sector agnostic. Anywhere innovation is happening, we would like to meet the founders and back them up. Some of our early stage investments in fintech are Citrus Pay, Bharat Pay, Bank Open, M2P, Jupiter, M1 Exchange, Tweed, Fi Commerce, Sopse, 42 Card Solution, Raise, Dhan App, few more.
Very difficult to follow on with Hero. kind of. I'm Sanjay Mehta, founder and partner at 100x.vc. We do the first check investing, which is more of a discovery platform. We write a 1.25 crore check to every seed stage startups. We invest in a class mode cohort based, and we only invest in Indian startups. Sector agnostic, but yes, fintech remains to be one of the largest chunk of startups what we would have funded across in all our cohorts. Till now, did over 105 investments through 100x.vc.
Vikram.
That's a tough act to follow now. I'm Vikram. I'm from ATI Ventures. I'm a former founder turned venture capitalist. Started investing as an angel in about 2007 in India. My thesis is very simple. I fund to remove friction from the lives of consumers and small businesses. I gravitated towards fintech because I thought there was too much friction in money. And so my investment has been a mix of brands and what I call rails, trying to make money frictionless. So some of the companies we've seeded include Carvale.com from way ago, and EasyTap, MoneyTap, First Check-in, M2P, Slice, EaseBuzz, SignZ, and a whole bunch of these companies. Primarily our thesis is, as I mentioned, to speed up the rupee. That's what we're trying to do.
Awesome. Nice. Adith.
Thank you, guys. I'm Adith Podhar. Before starting Gemba Capital, more on the banking side, private equity side, and as an entrepreneur. At Gemba Capital, it's a micro VC fund based out of Bangalore. We invest in seed, pre-seed rounds, sector agnostic, but fintech is a focus area for us. We've done around 10, 11 fintech investments. Some of them are Plum on the insurtech side, on the alternative investing side, Grip, Strata, Wintwealth. On the payment side, we have a company called Inai. On the fintech SaaS side, we have companies like Finly, Transact, and happy to kind of talk more about it going forward. Thank you.
Awesome, excellent. So I think we have a very good, fair representation of folks who've invested across different subsectors of the fintech ecosystem. Let me dive down into and make this conversation a little more serious. Let me start with Vikram, and let's hear Vikram's views on his overall views on what's happening in the early stage ecosystem. I think it's been a question on top of everybody's mind. We are all going through some sort of a flux. Everybody's, the whole high-end wave of 2021, we've all seen that. We've all enjoyed that. Some of us were lucky enough to exit in companies in that wave as well. And now last year has been a little difficult. How long is this going to be, this uncertainty going to be surrounding us? When do we see good times like 2021, etc.? Vikram, let me pick your brains on this first.
I guess I'm one of the few folks here who was a founder during the dot-com bust about 2 decades ago. There was a 99% wipeout back then, which has left a lot of scar tissue. And I think many people are making the mistake of comparing the dot-coms that died then with some of the cloud companies and payment companies today, which I think is incorrect. The correct comparison would be cryptos. So I think there will be a 99% wipeout in crypto, like there was a 99% wipeout in .coms. That's because if you don't have a business model, you will get wiped out. I think if you look at the client-server businesses back then, they are more similar to the cloud businesses. Uh, there was a lot of fear, a lot of, there's no investment happening between the period of 2001, 2005. And I remember when I would talk to people, Hero was, working at a hedge fund. I knew his colleague Vic. And I remember having a drink with him once and talking about Amazon. Why I say this will become evident to you. And so we're asking, those days people used to say, what is Amazon's business model? Like some people say, what is Cred's business model, right? And what Vic said to me was very interesting. He said, people can keep complaining about Amazon, but they keep buying. Right? He said the same analyst who's dumping on Amazon goes home and shops on Amazon. And I think when I look back, I realized that the internet continued running and all the companies which were providing the plumbing of the internet kept doing well. Of course, the valuations, came down. Similarly, when I look at fintech today, there was bad news yesterday from Mehta, there's been RBI regulation. The point of the matter is the digital plumbing of money ain't going away, right? You are still paying digitally. You're still receiving digitally. And this digital rupee is deepening across the country. So I think valuation is one thing. The need for digital plumbing is very real, and we have just begun. So my view is this is a really good time. You should be building. All the folks who are sitting here are investing in seed stage companies. So we are open for business. We think this is a great time. The land grab period is over. So that's my message. I don't want to dominate anything more on this.
Awesome, thanks. Adith, your take on this?
No, I completely agree with Vikram. I think some of the best of the companies are built of the times, the most resilient founders start, when they are ready and not when the world is ready, right? So, from a macro perspective, things are in place when you talk about India, right? It's just these economic cycles which will keep coming, going, partially due to some liquidity crunch in the US markets, and it's more, it does not affect when you really start thinking from first principles and starting a company, right, to solve a problem. So it's always a good time to start. All of us are obviously investing. There are many more with dry powder, and I think it's a good time to start. Clearly, for me as well.
So it's a good time to start, and you're open for business as well. You're investing as well. Awesome, Sanjay bhai.
I would like to disagree with Vikram that this is a crypto kind of wash down and things. I'm a big proponent of Web3. I believe, yes, we are at nascent stage, but these are the building blocks. We have seen, in Web2, when email was 1 MB, 2 MB, and suddenly nobody even now thinks about how the infrastructure is on the email side. The protocol layer, nobody even thinks across about TCP/IP or SMTP or POP or anything of. I've been through that whole journey about how those protocols were built across, and I see very similar stuff happening across today in the Web3 world. So I'm very bullish, looking forward to be part of those next giants in the Web3 space. So Vikram, you are missing out on that. I believe while a lot of the things about winter are being said across, and I don't know whether winter is there or not, but fear is there. So at least from the investor side of it, a lot of fear. I don't see much of fear with entrepreneurs. Most of them are going out, still building the stories, pitching across, building the companies. So I think as India is more or less insulated, what I feel across, Indian entrepreneurs will see a tremendous opportunity in these times when world over we are seeing across this fear seeping into even in the entrepreneur side of it. So this is India's story. We are unstoppable, I believe. So I'm on the cheerleader side for the early stage startups, kind of. So that's where I would like to end.
Cheerleader is okay, but are you putting your money where your mouth is?
Absolutely. We doubled down last year.
Okay.
In fact, we were doing earlier 25 lakhs per company. Today we are doing 1.25 crore per company.
Awesome.
So we just did 5 times the ticket check size for every early stage startup.
Awesome. Sometimes I think I should have been an entrepreneur rather than an investor, There's so much money floating around. But, let's get your views on this.
I think it's same. Early stage is cycle agnostic, so we invest through the cycles.
So you are investing now as well.
We are.
All right, folks. So, you have investors here on this side of the table. Everybody's open to business. Everybody says there's a winter, but, after talking to people here, it doesn't seem like the winter's too cold. So if you are entrepreneurs out there, looking to give your dreams some vision and some wings to fly, money's there. Awesome. Now that said, Vikram, you brought up an important thing, and I think Sanjay, you countered that. But I think the question was more about valuation. So as a moderator, I don't see you two saying two different things. I think you very clearly said that the plumbing and etc. from that dot-com crash remained, and that is where the new world was built on. The valuations crashed. And I think Sanjay, you, I think, agreed with that the valuations are in a flux, but the real reason for the crypto being around is still there. So I think we are aligned on that. But let's talk of valuations. I think the problem with valuations in our ecosystem, the early stage ecosystem, is that it's very opaque. At least it's opaque to third-party outsiders. And I think it's very, very opaque to entrepreneurs who are wanting to have conversations with this side of the table. And where do we start the valuation conversation? How do we start it? As a founder, if you thought that, $100 was the price in 2021, you reset that in 2022. We've now entered the next year. How do you see valuations going forward? And I think no one better to tell us about that than people here on the stage who actually invested in so many businesses that they mentioned and they shared. So let me go around the table once again and get your views on valuations. Just in a nutshell, what do you recommend to entrepreneurs who are now building new businesses? How should they think about valuations? And then something about the winter that we spoke about. Can we start with you, Sanjay?
Sure. I always tell my portfolio companies, right, valuations are not up for discussions. Focus on getting capital. Do not starve your company of capital, right? How many of you know Oyo rooms? Oyo, if you heard across, the first check was 30 lakhs, right? 30 lakhs at 11%. First check, 30 lakhs. Box 8, how many people you have heard? Great. 25 lakhs at 2.5 crore valuation, first checks. These are all companies which have built business of value, right? They are growing rapidly. They've built successful company from scratch because they never starved their company of capital. The first thing you need to focus is creating value, creating the company in such a manner that people will give you that valuations, right? I've been part of so many cap tables. Personally, I've invested over 150 odd companies, 4 unicorns in portfolio. I've seen all the journeys where no VC wants to run your business, right? They are happy taking haircuts, giving you back the equity if there is a value in the business. So first thing is think about creating value in the company and then think across valuation. That would be my underlying motto.
I agree with you completely. No VC, including me, we don't want to run your business. As I said in the beginning, if I knew how to run a business, I wouldn't be an investor, man. I would be running the business and asking for some billion-dollar valuations from all the other folks here. But Vikram, your take on valuations?
Look, at seed, there's not enough data, to be honest, right? So if you like the problem statement, you like the team, then in this environment, what we are trying to do is fund companies for 3 years. So we typically ask the founder to come up with a realistic budget, figure out how much they need, and basically try and fund them and not dilute them too much. That's broadly how we are thinking about it.
All right, so that sounds like a very balanced approach.
Yeah, we're just basically telling them, look, you're entering the Sahara Desert, and this is all the water you will carry. So if you're going to put your ego and say, my company should be worth X, Y, Z, whatever, it's not going to work for me, it's not going to work for you. I'm not trying to screw you, don't try to screw me, right? Let's be balanced, but let's make sure you have room to make mistake and keep a 30% buffer for worst case scenario, then you're good to go.
30% buffer.
Yeah.
All right. Adith, your views on this, valuations in the overall ecosystem and how you guys at Gemba are tackling it?
I think in the early stages, valuation is more of a negotiation and more of how much money does the company need, and then you have those standards 15-20% dilution in every rounds, and that's how you kind of come at a valuation. There is no point in any comparisons with any other startups because you hardly have any data, or each startup is different at the early stages. So I personally feel as you grow at late stage, it becomes more of a science, and you can kind of use DCF and various other methods. But at early stages, it's more about the kind of money you need to sustain, and then what is the kind of dilution you're okay for. And pretty much, I think it's a win-win in the early stages. Not much of discussions and debate happen on the valuation. It's either take it, leave it, right? Like,
So it's not much of a deterrent for you to invest in companies.
in early stages, I think once you've got the market, the founder, the product, all those things right, I think valuation is sometimes the last thing which you'll probably look at it, right? Because the maximum you can lose is the capital invested, but you do not want to miss out on the next Google just because it was highly priced, right? So a lot of investors at the early stages, I don't think so. They are so picky about it. As it progresses, you are looking at 25% IRR from your fund. Valuations become more important as companies grow. But early stages, I think you're just looking at the winners. So.
Excellent. Hero, your thoughts on this? Overall valuations in the ecosystem and how you guys look at it from as a firm.
I think mostly all the broader points are covered. We think that valuation is always given, not asked. In early 2000s, it used to be given. In last few years, it's asked by founders. And equation is just balancing out now. We clearly have, considering we want to be the investor before sunrise, meaning first institutional check, we have certain benchmarks on countries, sectors, the way we invest. We have a lot of historical data. And after that, we see if we like the problem statement, the founder, the team, what they're building. And that's how we work with the founders on how to approach the valuation. But that's one of the last thing in the discussion. First, everything else has to come together.
So I think the message from this side is very, very clear. Valuations are important, but they're never a deal breaker. As Adith said, you will never let a Google go just because it was highly priced when it came to you. Sanjay also shared some numbers in the beginning of some very known names in India which actually raised their first round capital at peanut valuation, because I presume valuation was not a conversation in those discussions.
And I've seen the journey of all these portfolio companies being the first check.
Yeah, absolutely, absolutely. So valuations, investors are not very sensitive to valuations. Valuations are a discussion that, like we said now, can be one of the last conversations to have. There are far more important things to be discussed before valuations. But somehow, why I brought this up is when you look at the press, when you talk to people, there's always a valuation conversation. And so therefore, please take this message away from this panel. Valuations are important, but that's one of the last things to be, negotiated or discussed.
Can I add here, Rajesh?
Please.
The thing which should be discussed, by founders has to be about the market, like what market opportunity is rather than valuations. I think that's far more exciting for any VCs to look at it. Everybody invest into market, right, in that sense. So that should be the point of pitching contention to discuss across.
Excellent point. Now, when we talk of the early stage ecosystem, you have 2-3 components. One is a very early stage where I think most of us on this side are now investing. We, let's say seed to Series A, Series B, somewhere there. And then those companies, as they mature, you have larger investors who step in. And those are also very important investors for both the founders' companies and for us as investors, because the next round of funding has to be coming from somewhere. Whenever we invest in any company, one of the things that we have to think through, and like Vikram said, we are funding them for 3 years. The question that we at this side are always asking is, okay, 3 years is fine. Now, after 3 years, if it does X, Y, and Z, what happens next? Who's going to come in with a big check? And this is where we've seen in the ecosystem, whether we like it or not, foreign investors become very important, because that's one of the larger sources of funding that has come into this ecosystem. I was looking at some data recently. Over the last 12 years, year on year, foreigners have put in far more number of dollars in the private segment in India compared to the public markets. Now, I presume most of us are familiar with public markets as well, stock markets. And whenever there's any correction, any major rise, we all talk about FII investment into the country. Last year, the FII investments into India were roughly between 15 to 20 billion dollars, somewhere there, give or take. The private ecosystem last year drew $80 billion in. So it's a huge source of capital for us, and I think one which doesn't get spoken too much about. Can we just get the panelists, I think let's start with Hero, of how do foreigners, in your conversation with other foreign investors into the early stage ecosystem, how are foreign investors looking at our ecosystem depending on where the maturity of that ecosystem is, how they are planning their portfolio, where does India stack in that? Are we seeing any let up in foreign dollars coming in, or you see that continuing as it was?
No, I mean, I think it's a pretty interesting point, and there are factors that are specific to India, and then there are factors that are global that are influencing that decision. Factors specific to India are pretty simple. We know 1 out of every 5 kids is born in India. Average age is in low to mid 20s. GDP per capita is rising. India took 75 years to come to 3 trillion. It will take only 10 a year or so to double it, which means a lot of things will get created. Digital out of total GDP as a percentage is growing, so more companies will get created, more market cap will be created, so on. So that's the India specific factor. Macro and other external factors are clearly certain countries or certain geographies where there is factors that are kind of similar, but at a little bit more maturity stage. However, because of any reason, they are no longer investable as they used to be. Which means flow of capital has to go where growth is, where regulation and regime is kind of a little bit more stable or investor friendly. So those things are driving how the capital flow is happening, and we are seeing more those discussions happening around India from across the world from different players, yeah.
Awesome. So the interest seems to be intact and in fact growing.
Yes.
Vikram, you would like to add something to that?
I mean, I think, look, there's an allocation shift happening. So it's interesting, 2 things are happening at an absolute macro level. If you look at the large allocators, pension funds, endowments, this January has been good for the US market, so stocks are rallying, but they seem to be over allocated to private equity and VC. So they seem to be tapped out a little bit. But if you look at the next 5 years, 10 years, globally, if you look at assets, 20% were allocated to Asia, 80% to the West. Of that 20%, 12 was to China. So that is getting recalibrated. So I don't know the exact number for India, maybe you have a better idea. But assuming it's even 3 to 4%, 5%, you move 2%, it's like a 40% jump, right? So you are going to see tectonic shifts of capital coming into India. Question is, can India absorb it? Does India have the regulatory framework? My biggest concern is there is too much volatility in the way we are governing the country in terms of regulations. We're tweaking too much. It's not stable. China was much more stable before COVID, if you think about it. So I think that's something the government needs to understand, that you need to build a more predictable regime. So if you ask me, that is the biggest concern I have. Otherwise, capital will keep flowing in.
Adith, how do you guys think about it? Because some of your companies will then need to raise those larger rounds.
No, I agree with Hero and Vikram here that in terms of India as a market size, it's always very attractive, and it continues to be attractive for foreign capital, whether you look at fintech or any other spaces. So if it's an allocation which is happening, and if China is not getting that allocation, that I think that money will flow back to India. So as long as the government and everything is stable, right, the macros are stable, money should continue to flow in India. In terms of, there are so many still large VCs who do not have a presence in India, right? And there's still so much capital out there when you look at mature markets like US. It's only going to increase once we build those kind of companies out here. Once we have many, many more companies which have that size which is possible, wherein larger and larger investors can come in India. And I think it will happen eventually with time. We've seen that happening over the last 5-6 years, where large investors have come, and I think more such investors will keep coming in India.
Let's move this conversation towards fintech. Given that that's the platform we have all gathered, on. Let's start with Hero on fintech. What are your thoughts? I mean, we keep hearing very different views, and I'm not going to share mine. First, I'll come back to it later on. There is one school of thought which says fintech is done. There's everything that needs to be done. Everything is out there. It's mature. Not many opportunities. While the other hand, there's so many people who believe that fintech is just about getting started. There's huge possibilities, etc. Where do you think we are as an ecosystem between these two?
Maybe early innings, maybe second or third inning, a lot to be done. Some of the earliest companies that are being built out, they are just laying down the pipes, and just maybe, okay, 100 people here. Anybody doesn't have a fintech app on their phone, raise their hands. Anybody? Look at it.
There's one. There's
There-
one. I saw one.
There you go. So you have one hand, okay? Hopefully that will also be converted at some point, So point is, there are everybody using these things, A lot need to be built out and a lot need to be done. However, it's a highly regulated industry, banking usually. It touches people's money, and it's extremely important that all the founders build out things that are kind of kosher. They build out in a proper manner. So for that to happen, there are times when RBI and others have to take some actions, which we think is very good thing. Once things are clearly defined, it's better to build out a product around what is the right set of the rules, and everybody plays by same set of the rules. So overall, we think it's really, really good. It's still very early days. A lot of new things will get built out. And yeah, I mean, like, we are just in the middle of closing a deal by some ex-Visa guys, new fintech company. Hopefully that will announce in a few months. But overall, we see a lot needs to be done.
Awesome. So the plumbing is just about done, and the whole structure has to be built now. So long way to go is what I'm hearing. Sanjay bhai, what do you think? You're seeing so many fintech companies.
I think we have just started. It's still early days. A lot of opportunities are there. And again, for me, comes back in terms of the way entrepreneurs are picking up the problems, right? So for example, in this room I can see Kuldeep, who is a founder of Pension Box. Now, pension has not been really worked upon. The opportunity suddenly comes across. So I think there are so many opportunities still to be mined across, right? And who better than Indian entrepreneurs building the story out, kind of. So I think we are at early stage, still a lot more steam ahead, kind of lot of opportunity for us to invest, discover. Like for example, we invested in a company called Credwise, which helps giving out credit card details securely, right? Today, not everybody has credit cards. People share credit cards details to everyone to avail offers, to increase more limit to buy more. Now, how do you give it securely, right? So many, I mean, it's just going viral. The app is just going viral. So things are still at early stage, I believe.
Excellent. A lot of opportunity. Anybody disagrees here on this side? Or we're all biased and we're all saying like, just about beginning?
So let me give some statistics, right? So I think we are fortunate that we have a central bank which gives out granular data on the fintech economy actually every single month. So you get data on all kinds of payments, RTGS, NEFT, UPI, credit cards, debit cards, POS terminal transactions, e-commerce transactions. So you actually get a pulse. And if you follow that data carefully, you can see trends emerging. And I'll give you an example. What we did, in 2016-17. I remember I was visiting Brazil, and I happened to meet the founder of Nubank. We had just done Series A through a friend of mine. And he was very articulate and eloquent about the credit card opportunity. And it seemed like an underserved market. The interesting thing was they had 70% card penetration. Meanwhile, in India, we had 1% card penetration. And so when I came back, I started to read up on, what maybe the opportunity set. So I talked to a lot of bankers. So what I want to talk about is be afraid of narratives, particularly coming from many of the incumbent banks, okay? Because this is a country where every 5 years there's a new generation which is emerging, right? So every single banker I talked to, they were saying to me that you cannot sell credit cards in India, it's not a growing market. I said, why? Because there was this whole idea that there are 25 million people who pay income taxes. These are the guys who have the cards. They're the ones who buy online and, they have postpaid phones and so on, right? Guess what? When I looked at the data, credit card spends were growing at 37% a year. The CAGR was 32% over 8 years. So data was saying something else, but when you talk to the bankers, they were saying something else. And I was just invested in Slice. He was financing smartphones. And I talked to Rajan. I said, listen, I think there's an opportunity to launch a challenger card. Let's start with students. That's how Rajan began. And when we turned around, we tried to find a company which would power these cards. We really couldn't find one, but we found one obscure company called M2P in Chennai, right? So we met the founder, and cards was one of the things he was doing. He's starting to double down. So we came together. Then Hero's company fund came in as well. So this is how data actually informed us of an opportunity that was emerging. When we look at data today, what is really interesting is India's retail economy has gone from 80% cash pre-COVID to 80% digital, maybe 75%. What that means is $750 billion of payments are being accepted by merchants today. India's economy is getting formalized. That whole cash concept is going away. It's only in real estate mostly. Look at your pocket, see how much cash you're carrying and how long you've been carrying that cash. We are only using it to tip the valet today. That is the reality, right? So where is the next opportunity? It's these people who are getting formalized. Will they not use digital tools? Look at the amount of QR codes that are there in this country. What are the problems? So digitization also brings new problems. If you're not used to it, reconciliation is a problem. You have a complex GST system and so on. I'm not going to monopolize the conversation, but what I'm saying is, if you look at the data, don't bother what the media is saying. It will tell you everything, and that's why we think we're in the beginning. India's just gotten formalized, the small business economy.
It's a very interesting point. So, of all the people that are here in this room, how many of us are using cash for everything that we do? Or how many of us, wrong question, how many of us are predominantly using cash for day-to-day transactions? There's your answer. So this is a very biased segment of the population, and we all understand that. This is not representative of India, but that's what his point is. That's the opportunity. There will be a time when if you go to tier 3, tier 4, you should have this answer when you ask about use of cash, right?
Just 25 crore people every month transact on UPI. That's the number. Confirmed by the chairman of NPCI, by the way.
Let me just add a couple of more points.
Yeah, please, coming to you.
If you look at it, credit card penetration is still 6%, I think, compared to 80% in developed countries like US, UK. There is a long way to go in every subsector which you look at fintech, right? It's just the tip of the iceberg. People think fintech is done, payments is done, but every time the companies evolve and something new happens because of the entire infrastructure which is built, whether it is India Stack or whether it's account aggregator, there is so much more to be done on the insurtech side. It is still, we're using legacy systems. There's hardly any, maybe 1% penetration of insurance, right? You look at home loans, the way it's still not digitized. You look at the lending credit area, majority, 80% is still lent by banks. Like there's like proper 50, 60 million MSMEs which are still using informal credit, right? So there is a whole world out there within fintech, and there are a lot of areas which we feel are open for disruption, and founders should be building in that.
Awesome. So I think there's a very consensus opinion here that the opportunity is huge on the fintech side. So within fintech, and I was reading some data and we were discussing briefly before the panel here, but let me bring it out so that we all have the benefit of that conversation. I was recently looking at some data put out there, and it was comparing listed market companies versus those players who want to be listed or who are the next in line to be listed. And within the fintech ecosystem, we have Paytm, which got listed recently, some time back. And we all know the Paytm saga, etc., etc., etc. But that's not the point we are belaboring here. Uh, it is about how companies, when they move from private markets to the public market, if they want to make that shift, and I believe most of them will want to at some point in time, how will the public market investors value those companies? And there are so many nuances in there. I think one of the bigger things that I've been repeating a lot is that Paytm should have actually educated listed market investors far better than they did. That would have saved everybody a lot of heartache, etc., for the whole ecosystem as well. But that aside, Paytm has an ARR of roughly $800 million, at least as far as the recent numbers out there, and a market cap of roughly three and a half, thumb rule wise, $3.5 billion. So a multiple of about, let's say, 5 or somewhere there. The next 5 companies, large fintech companies, right, without taking any names, the next 5 in line have an ARR of roughly $1 billion. So $800 million Paytm, and $1 billion roughly for the next 5. And the market cap of Paytm is $3.5 billion, with a market cap or the market size, market valuation of the unlisted 5 players is roughly $35 billion. So you see the disparity and the disconnect. And I think all of us on this side of the table are investors in some or the other fintech company. So here's a question, Vikram, and let me start with you. Are we looking at, you personally, are you looking at companies from your portfolio really wanting to get listed? Is it a matter of the timing in the cycle? Or how are you thinking of valuations for those companies that are wanting to go public in the fintech ecosystem?
Fortunately or unfortunately, I don't have these 8 companies in my portfolio, which are worth 35 billion. So whenever we look at a portfolio, when we look at a company at seed, we like to think of this company growing to about $100 million in revenue over time, right? So I will tell you, every single company, at least in our first fund and also in the second fund that we've seeded, we look at from an IPO perspective. Right? If you don't have that IPO opportunity, it's not worth doing. That's the way we look at it. And we look at the number of 100 million in revenues. Typically, we look for 50 to 60% gross margins, if we can get there, right? Then you can arrive at maybe 25%, 30% EBITDA margins. And in a good market, Indian market gives you 30 times, 35 times at EBITDA, so you have $1 billion outcome. For a small fund like ours, it's the outcome we want, which will get us home. Now, when we are looking, so why we like fintech in particular? Because the scale is so vast, right? So coming to the question of valuations, look, there will be valuation overhang. I think that so much money was raised towards the end of this year in 2024. A lot of companies will go back to VCs to raise. And that's when the VCs, if you're a big VC, you'll try to consolidate. So there'll be consolidators and those who get acquired. So the guys who have, cash and valuation, they will just keep acquiring and grow into that valuation inorganically. And those who can't raise will just keep getting acquired. There'll be a clearing. That's what will happen. And ultimately, also many of the big VCs are waiting for these leaders to emerge. And that's basically how I think the cycle will play out.
Awesome. Excellent. Very precise and insightful. Adith?
No, I feel always private market valuations should be less than public market valuations. You have an illiquidity discount, you have a size discount, but what we see in reality is the other way around, wherein private market valuations are higher when you talk about multiples compared to public market valuations, which is itself, would probably correct. And I don't see there is always aspiration for the founder to go public, but maybe it's not always the right choice, right? Like, when you can actually get better valuations on the private side, stay private, or maybe you do a strategic, you might get a better value unlocked, because it's not so easy, right? Like, the entire DNA, the entire culture of the company needs to change. Public markets are not forgiving, right? So I personally feel that in India, you'll see more of M&As happening, more of outside companies also buying out Indian companies, and I think that would be give a good exit to a lot of early stage investors and VCs and even Series A, Series B investors, right? So that's how I look at it.
Excellent. Sanjay, your thoughts on the same?
Rajesh, I don't understand public markets. ना ratio समझ में आता है, ना कोई chart समझ में आता है. So business धंधा समझ में आता है. So You go by business, how good the entrepreneur is able to build a business, kind of stuff, and what's the business story, kind of. So let me put an anecdote here, kind of. Let's assume there are entrepreneurs. You are here in the room, dhanda kar rahe ho. Let's say you get a opportunity to put a food stall in a lane, and you got one advantage over rest of the guys, right? One advantage like price, you can have across quality, brand. What will you pick across? What is that one advantage you will seek across so that your business will do very, very well? Price, brand, quality of food? No answer? Quality. I would pick across a hungry crowd. The market चाहिए, right? Hungry crowd है, कुछ भी रहेगा, बिक जाएगा. If I'm running a food stall. So even with all the regulations, right? The fintech market is going to be there, even if with the ups and downs, whatever you would call across. Because we have a hungry consumer market. They are looking for solutions. They are looking for ease of doing their work, business, life, everything, right? So if a solution is there, which is going to solve my problem, irrespective of whatever the RBI will do or any regulator will do, it will still work out. So look at business. That's where I come from, not from the statistics or numbers. I don't understand.
So all of us who are looking at talking to 100x, please remember market size, market size, market size, opportunity. Sanjay will get convinced. But let's get to you. So this whole transition from private markets to public markets and the valuation differential, etc. What are your thoughts on the same?
It's complicated. So first of all, not all revenue is created equal because companies may have different gross margin profile, so they may have different gross profit dollar on same dollar of revenue. Second is public markets mostly trade on discounted present value of future discounted cash flow. Privates demand and supply. How many VCs like the business model, how many want to fund how much capital. So there are clearly differences. Third, valuation over time does compresses as company and business matures because growth rate slows down. When you do early stage, if somebody is investing in the company before founder invested, there is no revenue, nothing. Valuation is infinite. Whatever you give, right? In the first check, it may be 100x, 200x, and then goes to 50. So it compresses. It need to grow into the valuation. They say, right? And lastly, I will say is that when you make that statement between the difference, it assumes that either one is right, but we don't know either both can be right or both can be wrong, and they are a snapshot in time. That being said, clearly, there are some businesses that may be overvalued, but you can also make a statement if Paytm is undervalued. So, yeah.
Exactly what I wanted to hear, you know. No, fantastic. Thanks. Thank you. I think let's get a little micro now, and let me go around the panel asking each of you about your views on changes in the entrepreneur profile. You know, we all meet so many entrepreneurs every day. You're seeing so many decks. You're talking to so many entrepreneurs across businesses, you know, and business stages as well. So, you know, just let's go around this panel and understand from you, and let's start with you, Adith. Pre-COVID, post-COVID. And why I'm taking COVID is because COVID was the big changer in terms of the whole ecosystem's maturity. You know, it was an accelerator sort of. So what are the few differences that you see, or even if you don't, then, you know, that's the answer, between the profile and maturity, et cetera, or traits of promoters, founders, pre and post?
I think one thing I clearly see is maybe it was because of COVID, but a lot of founders were those who were working 10 years, 15 years in other traditional BFSI companies, right? So they had the domain expertise, they were working for someone else. Maybe COVID made them think that, you know, let's start something of our own. We are as it is working from home. So I see a lot of founders now who are coming with a good 10, 15 years of work experience in large companies and then starting up. Obviously, whether it is they're going to be successful or not is as compared to a 24-year-old is anyone's guess, and there are a lot of other factors. But I see that one change which is happening, and these founders I feel are more grounded in the sense it's not easy for these founders to kind of just start and splurge and just rely on VC money. So they are more cautious. They know eventually what an EBITDA looks like. They've seen that when they're running their own departments. And the company from day one, the foundation is built in a way that growth will be there, but it will not be, completely, wherein the unit economics will not be kind of, sacrificed for that. So that's
Thanks.
what I see in one set of founders. Yeah.
Great. I've just been told that we're running out of time, so I'm just going to go around the three of you quickly, one or two sentences on any change, if any, in terms of founders that you interact with.
I think we are past the stage of the mercenary founder, right? Because if you're going to step out today, you're not going to have a guaranteed $1 million check waiting for you. You have to have real conviction and a real belief that you can't sleep till you solve this problem. So we are going to find more authentic founders. We're starting to see a trickle of those. Mostly what we are seeing is people who raised before are coming back to raise a little bit more extension-wise. But the rise of the authentic founder is just happening.
So I believe the current set of founders, what we are seeing across, are coming from students. Right? Student entrepreneurs are coming thick and fast. Quite a lot of college incubation centers, the AICs, are breeding new set of ideas. These kids are burning candles at both the ends. So I'm a strong backer now of student entrepreneurs, right? And I believe these young minds have got crazy ideas to solve Bharat or India's problem.
That's nice. Hero?
No, I think same. We see ecosystem getting denser and better, bolder founders coming out here.
Awesome. Thanks, everybody. I think we run out of time, but it was a great
Thank you.
conversation. Even I
Thank
learned
you.
some bits. Thank you.